The map is spread across a polished desk in Washington, D.C. It is the 1930s. Entire neighborhoods are shaded in red, not because of crime, not because of infrastructure, but because of who lives there. A banker stands nearby, waiting. The map will decide everything: who gets a loan, who builds wealth, and who is quietly locked out of the American dream. A family sits across town, unaware of this decision. They have stable jobs. They have savings. They want to buy a home. But when they apply for a mortgage, the answer comes back quickly: denied. Not because of their finances, but because of their address. This is not an isolated decision. It is a system that transforms geography into destiny. How did a set of maps drawn nearly a century ago shape trillions of dollars in wealth? And why do their effects still define the modern economy? This isn't just a story about discrimination. It's the story of a financial architecture, one that quietly determines who builds wealth and who is excluded from it. In the aftermath of the Great Depression, the American housing market is broken. Banks are collapsing. Mortgages are short-term, risky, and often impossible to repay. Homeownership is unstable and rare. The federal government steps in with a solution. It creates institutions designed to stabilize housing finance, most notably the Homeowners Loan Corporation. Its mission is simple: assess risk and standardize lending. At its core, the idea is rational. Banks need a way to evaluate whether a borrower will repay a loan. The system introduces long-term amortized mortgages, loans that can be paid off gradually over decades. It is a revolution in finance. For the first time, millions of Americans can realistically buy homes. But there is a problem. Risk must be measured. And in the 1930s, the tools to do so are crude. So the system turns to geography. Imagine a lender trying to predict the future. Will this neighborhood grow or decline? Will property values rise or collapse? Without modern data, they rely on proxies, visible simplistic signals, income levels, building conditions, and critically, racial composition. The solution becomes a map. Cities are divided into zones. Green areas are labeled best, safe investments. Blue areas are still desirable. Yellow areas are declining, and red areas are marked hazardous. This is the mechanism. Step 1, assign a risk rating to a neighborhood. Step 2, tie mortgage availability directly to that rating. Step 3, allow capital to flow only into safe zones. It is clean, it is scalable, it is devastating. Because once a neighborhood is marked red, banks systematically refuse to lend there. No mortgages, no refinancing, no investment capital. And here is the central paradox. The system designed to reduce financial risk begins to manufacture it. A neighborhood without investment cannot grow. Property values stagnate. Infrastructure deteriorates. Businesses avoid the area. The original risk becomes a self-fulfilling prophecy. This is not just policy. It is feedback loop engineering. The model spreads rapidly. Private banks adopt the same logic. Insurance companies follow. Developers build where credit flows, away from redlined areas and toward the suburbs. Meanwhile, millions of Americans, disproportionately black families, are locked out of homeownership. To understand the scale of this, consider what a home represents financially. It is not just shelter, it is leverage. When you buy a home, you are acquiring an appreciating asset, often with borrowed money. As property values rise, so does your net worth. You can borrow against that equity. You can pass it down to your children. Now imagine being excluded from that system entirely, while suburban homeowners accumulate wealth over decades. By the 1950s and 60s, the system is deeply embedded. Entire metropolitan areas are structured around these invisible boundaries. Highways are built to connect wealthy suburbs. Schools are funded by local property taxes, reinforcing inequality. Businesses cluster where capital is abundant. Then comes the first major rupture. The civil rights movement forces the system into the open. Activists, researchers, and policymakers begin to expose the patterns. Studies reveal that lending decisions are not purely financial. They are systematically biased. In 1968, the Fair Housing Act is passed. It outlaws explicit discrimination in housing. On paper, redlining ends. But systems do not disappear overnight. They evolve. Banks stop using explicit racial maps. Instead, they adopt more complex models: credit scores, income verification, debt ratios. These appear neutral, and in isolation they are, but they are built on a foundation shaped by decades of exclusion. If your parents were denied home ownership, you're less likely to inherit wealth. If your neighborhood was underinvested, your property values are lower. If your schools were underfunded, your income potential may be reduced. The inputs to the system are already unequal, so even without explicit redlining, the outcomes remain skewed. Then, in the early 2000s, a new chapter begins. The housing market is booming. Financial institutions develop complex products: subprime mortgages, mortgage-backed securities. These are loans packaged and sold to investors. On the surface, this looks like inclusion. Credit is expanding into previously underserved communities. But look closer at the mechanism. Subprime loans carry higher interest rates and riskier terms. They are often targeted at borrowers in historically redlined areas. In other words, the same neighborhoods once denied credit are now flooded with it, but under worse conditions. This is the catalyst. When housing prices stop rising, the system breaks. Borrowers default. Securities collapse. The 2008 financial crisis unfolds. Trillions of dollars are lost, but the impact is not evenly distributed. Studies show that Black and minority communities, many of them previously redlined, experience disproportionately high foreclosure rates. The cycle repeats in a new form. The algorithm processed billions in mortgage-backed securities. The consequences played out in empty homes, lost savings, and shattered communities. Today, the maps are gone, but their imprint remains. Look at modern wealth data. The median white household in the United States holds significantly more wealth than the median Black household. A large portion of that difference is tied to home equity. Look at property values. Neighborhoods that were redlined decades ago often still lag behind in appreciation. Look at investment patterns. Capital continues to cluster in areas already deemed safe. This is the modern thread. Redlining is no longer a policy. It is a legacy system embedded in financial data, market behavior, and institutional memory. And it extends beyond housing. Consider credit scoring. It is a tool designed to measure individual risk, but it reflects past access to credit. If your community was historically excluded, your starting point is lower, or consider private equity and real estate investment trusts. These modern vehicles allocate capital at massive scale, often reinforcing existing patterns of profitability, again, favoring already wealthy areas. Even emerging markets like fintech and crypto are not immune. Access to technology, education, and capital determines who participates early, and who benefits most. The architecture persists, so how do you analyze it? Think in terms of three variables. First, access to capital. Who can borrow, invest, and leverage assets? Second, cost of capital. At what interest rate, under what conditions? Third, asset appreciation. Where does value accumulate over time? When these three align, wealth compounds. When they are restricted, wealth stagnates. The lesson is not that the system is static. It adapts. It becomes more complex, more opaque, but the underlying mechanism remains the same. Capital flows toward perceived safety, and perception is shaped by history. So return to that map on the desk. It was never just a piece of paper. It was a model, a simplified representation of risk. The officials who drew it believed they were stabilizing the system. In many ways, they did. But they also encoded a bias into the foundation of modern finance. The family denied a mortgage wasn't just unlucky. They were positioned on the wrong side of a system that translated geography into opportunity. Understanding this isn't about assigning blame to the past. It's about recognizing the structure that still governs the present. Because the next financial innovation, whether it's in housing, technology, or global markets, will follow the same logic. It will promise efficiency. It will claim neutrality, and it will depend on assumptions about risk. The question is whether we recognize those assumptions before they shape the future. Because the lines on that map may have faded, but the system that drew them is still very much alive.